Hello, my name is Michael Joyce from JoycePayne Partners. I'd like to take the opportunity today to impart to you some of our views on the financial markets for the spring of 2014. And I'd like to start this out by talking about two anecdotal stories. The first story goes back 3 decades to the mid-1980s, and I was attending a luncheon at the Municipal Bond Club of Philadelphia, and I sat at a table for lunch with an older, more grizzly bond trader who seemed pretty ancient to me at the time, but in retrospect was probably about 50 years old, which seems very hale and hearty to me at this point in my life. But this bond trader told me, or gave me some advice that I think about almost every day. We try to put in practice here at JoycePayne Partners. And that advice is to never mistake a bull market for brains. And that's pretty important. I mean, we clearly are in a bull market right now, at least in the U.S. equities markets. 2014 started the year at record levels, and the modest gains that we've had so far this year have perpetuated those records. And those records have been occurring at a time where valuations are now on what we would consider the high side of fair value. You know, the past 18 months or so, it has seemed pretty easy to make money in a market where things have been constantly rising and with pretty low volatility. And one of our concerns is that this has created some complacency among investors. My other story just goes back a month ago. I was in California at the biannual investor conference for Oaktree Capital, and the chairman of Oaktree Capital, Howard Marks, is really a venerable soul in the investment markets. And somebody asked Howard, when is the best time to invest? And his reply was, the best time to invest was 5 years ago. And he was clearly right about that. And if you think about 5 years ago, it was in the midst of the financial crisis, and returns have been pretty strong in almost every asset class you can think of, particularly the riskier assets. What's really important is to look out at investments 5 years from now. In 2019, will we look back at 2014 and say, boy, I wish we'd been more aggressive during that period? Or will we look back at 2014 and say, boy, I wish we'd been a little bit more cautious during that period? But the hard part comes when things start to get choppy. And we do think that things will get choppy at some point. It's now been nearly 2 years since there's been a dip of 10% or more in the stock market. And if you look back at the past couple decades, the average intra-year drawdown from peak to trough is about 14%. And the majority of those years, they were up years. So in some years, they were very strong up years with 20% plus returns. And they still had a pretty significant drawdown in the course of the year. So even in an upward moving market, we would expect that there will be some dips and volatility along the way, and they can create opportunities. The choppiness is a period where it's going to be very important to have a diversified portfolio, one where we're on the lookout for undiscovered opportunities and managing risk. Turning to the global bond and debt markets, so far in 2014, these markets have done pretty decently. If we roll back to last year and recount the action since then, last May, the bellwether 10-year Treasury note had a yield of 1.61%. And over the next couple months, interest rates rose pretty rapidly, so that by the end of the year, the yield was 3%. Now, as many investors know, as interest rates go up, bond prices go down, particularly on longer-term bonds. So people that were invested during that period in the bond market, especially in the longer-term bonds, suffered some pretty negative returns. Where we stand right now, the 10-year yield is at 2.75%. So it's down from the highs, but it's still significantly higher than where it was last May. At JoycePayne Partners, what we continue to look for in the bond markets are to look for bonds that have little risk of impairment in our minds, that will protect us against rising interest rates, and that will give us a decent premium over inflation. And we do think here at JoycePayne Partners that interest rates will continue to go up, but we don't know exactly when they're going to go up and how rapidly they're going to go up. In fact, they may go up a lot slower than some prognosticators think of because of persisting sluggishness in some global economies. Speaking of global economies, the international equities markets have been flat to slightly up for the year. The emerging markets started down at the beginning of the year, but have come back quite nicely over the past couple months. There's been some markets like India that have actually performed pretty well so far this year. The one region that I'd like to talk about today is the European markets, which have performed really pretty well since the depths of the euro crisis a couple years ago. However, we do think that there's still room for some concern in those areas. The economies there are growing at a very sluggish rate. There are hints of deflation in the region, and the unemployment rates remain very high. In the United States, our unemployment rates have been coming down over the past couple of years, but that has not yet started to occur in Europe, so we remain cautious in those areas. In other asset classes, for example, commodities and precious metals, they've done really pretty well so far this year after having terrible returns for the prior 18 months or so. And our thought in those areas is because of a lot of the global sluggishness and demand for commodities that there will be some sluggish returns in those areas as well. Real estate and tradable real estate investment trusts have done very well so far this year. Real estate investment trusts are up 10% year to date, and that's been very good. It's been one of the top performing of the major asset classes. However, we have turned somewhat cautious on real estate investment trusts, and one of the biggest reasons that we've turned cautious is we're concerned about the potential for expansion of cap rates or capitalization rates. Now, what I mean by that is most investment real estate projects are valued using a capitalization of net operating income. And as the capitalization rates go up, the value of the real estate goes down, and vice versa. Now, as I mentioned earlier, interest rates are fairly significantly higher than where they were about a year ago. But yet cap rates did not rise in tandem with that. Indeed, a lot of real estate investment trusts are paying fairly low capitalization rates for a lot of their real estate projects right now. So our concern is that if interest rates do rise at some point, as we do expect, that capitalization rates will then rise, and that would have a negative impact on some of the prices, especially some of the prices of the real estate owned by real estate investment trusts. This is just a small nutshell of some of our thoughts on the financial markets here at JoycePayne Partners. For more in-depth information on our thoughts on the financial markets, I invite you to go to our website, which is www.joycepaynepartners.com. And thank you, and have a great day.